Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. This week, I'm joined by Pranav Kanade, portfolio manager of VanEck's Digital Assets Alpha strategy. VanEck is an American investment management firm headquartered in New York City with over $100 billion in assets under management. Although they're well known for their passive exchange-traded funds, or ETFs, they also manage active portfolios such as Pranav's Digital Assets Alpha strategy. Pranav joined VanEck in 2022 from Millennium Management, where he was a credit portfolio manager working closely with a team of 6 investment professionals. Prior to Millennium, he was a founding member of the head of research for the liquid credit investing business at Angelo Gordon & Co., and he also spent time with Hutchin Hill Capital focused on technology and energy, and also with UBS. In this episode, Pranav and I dig into his jump from TradFi into crypto, the realities of investing in venture through liquid, publicly traded assets, and the differences between traditional VC-style assessments of early-stage investment opportunities and liquid token-style assessments. We also talk about the catalyst for growth in digital assets and how his liquid venture strategy fits into the wider VanEck investment management operation. All right here on Money Never Sleeps. Well, Pranav, welcome to the show. Great to have you here with us.
Exciting times. I'm glad to be doing this.
Yeah, thank you. And in prepping for our chat today, Pranav, I had a quick look at your LinkedIn profile and I saw some interesting things on there. And it looks like you had been pretty TradFi focused with UBS, Hutchin Hill, Angelo Gordon, and Millennium, who I've got a tiny bit of experience with, before you jumped into VanEck back in 2022. Can you just give us a look inside your backstory and what was it that inspired you to jump into digital assets?
Yeah, it's a great jumping off point, but it's pretty funny. So VanEck is a large asset manager with essentially a family that controls the entire business. So Jan VanEck is the CEO of the firm. And when he first saw my resume, his response was similar to what you just said, but in a more direct way, which is great resume. What does it have to do with crypto? And as you can tell, I spent 12 plus years in the world of public credit and equities, looking at just sort of regular way businesses, running essentially a long short strategy across the board. Came across Bitcoin in 2015, didn't really make much of it, thought it was sort of an asymmetric call option, so got involved. But then everything else was introduced to me in 2017. It was kind of expanding on the idea of Bitcoin. You know, Bitcoin was trying to be peer-to-peer money, peer-to-peer cash. And the idea was, well, if you can add programmability to that, then you can start to build sort of interesting applications. And that first application was raising capital, which is the ICO mania. And, you know, I'm a traditional markets guy. I look at all these things and say, well, what's the business here and how do they make money? And what does that mean for all these projects that are trying to raise capital and have a token? All that was not clear at the time in 2017. There are a couple of prediction market-like platforms that were raising capital at the time. And so what I said was, look, I'm going to try and use these products and see if there's something novel and interesting about these products, and then decide ultimately, how do I get exposure to them? Fast forward 2018, these projects start to ship their products, and it was extremely disappointing for everyone. You know, most of these things were kind of not usable. And at the same time, you know, obviously the regulators started cracking down on these ICOs. So I kind of more or less, you know, said the odds of this whole vision of applications being built on public blockchains, getting rid of intermediaries, and ultimately having more of the value created accrue to the participants of these networks. That's all a great vision, but the products are just not there yet, and it's going to take a long time. And I, you know, in my brain, I think of everything in terms of probabilities, and I said probably a 5% chance all this stuff works, you know, goes mainstream one day. But I continued to follow everything, and you know, I came across Binance in 2019, and I, you know, looked into the platform. It was essentially this centralized exchange where people could trade different tokens, but also they had this launchpad thing where people could launch their projects. They had a perpetuals, or at that time they had a margin trading platform, I think. And so you had this full suite of products, and the suite of products generated some cash flows, and all those cash flows seemed to be going to this BNB token, or at least a vast majority of it. And this BNB token was also being used as a customer acquisition tool and to grow the underlying business. And, you know, the traditional markets guy in me kind of realized, wow, this is super interesting. Tokens are essentially, you know, equities 2.0 in some way, shape, or form. It takes a stock and then gives it kind of these superpowers to accelerate growth. And so I started to think about that. But then again, there was not that many products and projects with tokens that made a lot of sense at the time. But then fast forward, 2020 happens, COVID happens, and then you kind of have the first wave of DeFi. And that's when you start to play around with the actual products themselves, like a Uniswap or an Aave, and say that, okay, these are pretty good as products compared to the 2018 legacy. And then the token things make sense, right? It's a way to capture value, but also accelerate business growth. Dots started to connect in many ways for me. And the thesis I kind of articulated to myself was the right form of tokens that represent ownership of an underlying business, most likely a software business, is a better capital formation tool than a stock or a bond. And tokens ultimately will be the evolution of stocks and bonds. And the equity and credit market is a $270 trillion market. The token market, even today, is around $600 billion. And there's some probability that that $600 billion market will eventually take a ton of market share from that $270 trillion market. And as that happens, you're going to have a ton of winners and a much, much larger number of losers. I actually think a lot of that value creation in the token market will likely happen between 10 to 15 projects. So essentially, I wanted to create a framework for myself to be able to pick winners as that happened, and ultimately, risk manage that portfolio, because crypto seems to go in these hype cycles of despair and euphoria, and you want to sort of manage your portfolio through that. Didn't really see a lot of folks doing that. You had a lot of smart people doing VC, sort of pre-seed and seed venture, but the liquid markets were equally interesting. As they nuance in the space. In the public markets, companies go from seed round to IPO in an average of 6 years. In the token markets, things go from seed round to liquid token, in a span of 18 months. So these are venture-like businesses with liquidity. So you can have venture-like upside, but obviously venture-like downside. Again, the liquidity is helpful because if you can identify when one of your bets is not playing out, then you could actually exit versus, in the traditional venture markets, it's hard to do that in that stage. So there's a lot of interesting things about this market that drew my attention. The biggest one being there's not that much institutional capital really participating in the space. Most of it is retail. And for the thesis to play out, which was the $600 billion market taking share from the $270 trillion market, the space has to institutionalize, and we might as well be first was kind of a logic. So I had this framework, the strategy. I ultimately pitched it to Jan VanEck. We had these long conversations over 6 months, and he agreed to sort of seed us. We started the strategy under the firm, under VanEck. VanEck had a pretty long history of being in the crypto space. They've been in the space since 2017. I think VanEck was the first Bitcoin ETF applicant. So Jan, deeply understood what the space was about. And so we started the strategy in 2022, been running it for about 2 years now.
Wow. And back to one of your points on finance, right? Do you ever think much about and I'm sure you have, but the centralized context of Binance and the BNB token? And like you said, almost like an equity 2.0.
Yep.
Versus a decentralized network where the token is truly representative of the value of the wider network, which is decentralized. How much of your thinking went into that distinction versus just, hey, this is a new way of capital formation for equity?
At a very high level, there are several benefits that come from leveraging public blockchains and smart contract platforms. One of them is programmability, and that's the most interesting aspect. So putting an asset on a blockchain allows you to do different things with it that you couldn't do if it was just sitting on a ledger at the DTCC. To me, that is the most interesting aspect of this asset class. Now, at a different level, we look at tokens and we say there's two types of tokens that are in a very basic level here. So there's blockchain native tokens, which are essentially software businesses built natively on a blockchain that have a token attached to it. And then there's real world assets that are going to get tokenized and they're going to end up on a blockchain. Yeah. Both have sort of similar properties. One is different in the sense that it's saying my underlying business itself can be reconstructed in a decentralized, distributed manner such that the end result is a better, cheaper, faster product to the users. And that has obviously this token element attached to it, and that sort of leverages this decentralization element. The other side of it says, look, a regular way business that produces physical things in the physical world does not need to really decentralize. but it could still benefit from having its ownership instrument be a token.
Yeah.
So those are just distinctions.
Yeah.
And, you know, when I see one try to be the other, then it's kind of like, what are you trying to really do? Right? Like an exchange is supposed to ultimately serve a product that is cheap, is essentially offering cheap trading fees for its end user. The goal is cheap trading fees, high volume, high depth, right? You can achieve that potentially in a decentralized way or a centralized way. But then the key element with the Binance case is the token itself, which is the value accrual tool, can be used to accelerate both the liquidity provisioning side as well as the folks coming into trade side, which is what you need, both those things for the marketplace to work. And so the token is used in many different ways. I don't know if that answers that question.
No, it does.
Yeah.
It does.
Yeah.
No. And I think we're along the same lines in that when I look at a business that's proposed to me and that where it is a centralized company with a token that is part of their strategy and that there's no hope of it ever becoming decentralized, I'm like, well, that's just loyalty points, you know, and that they might have had trouble raising via equity last year. And so they're like, well, let's try and raise via token. So those are pretty transparent. You can see that. There are some that are on the other end, like we talked about, where it's clear that for their protocol to operate and for that to be able to operate in a decentralized manner, where developers can just build on that network, that they need that token to operate the network. And that token is representative of the value of the overall network. And great, that's the other end of it. And that's the true decentralized component. Sometimes you get stuff right in the middle, though, that I like, where it is that it looks like a centralized company. It starts out as one. They talk about a token and perhaps launching a token down the road. And that because what they're building underneath everything is a protocol that could be used by other projects that others could build on at some stage. And so it's kind of, you need to ride both sides of it and keep an open mind about, well, this could become a centralized company. This could become a decentralized, but there really is, you have to pick one way or the other. You know, you can't do both.
I have a little bit of a simplistic view, which is the token is obviously never the product. A great product is a great product, and the token can often act as an accelerant to that adoption of that great product. And you know, I don't really care if it's centralized and decentralized. The user doesn't really care, right? Like everyone gets really hung up on like the 10 to 20 million people using apps on chain today, and I keep focusing on, look, there's like 5 billion people with an internet connection. Like that's the grand prize. And so the products they want to use, they don't really care, like, you know, about the details of which blockchain it's on, how decentralized it is, you know, how censorship resistant something is. You know, they just care about great user experience and like, let me do the thing I want to do with minimal friction, minimal clicks. And, you know, if there's sort of this token element that makes it even better, great.
Yep, I'm with you. And it's funny because when we did our TechStars Web3 demo day 2 weeks ago, like I mentioned to you, I had a couple investors say to me, what the hell did some of these companies have to do with Web3 and blockchain? I'm like, exactly. That's what I wanted you to say, because I wanted it so buried beneath the value proposition that all you're thinking about is just, where's the token? And I'm like, don't worry about it. What they're building is incredible. Have a look at that deeper and you'll get it, right? So
I've been a big follower of Elon and Tesla for a long time. I'm a big fan. You know, I think as everyone knows, Elon's trying to evolve the company from selling cars to selling rides, right? Through this whole vision of robotaxis, right? So essentially, you know, your car that you purchase should be able to just drive around like an Uber and pick up people, drop off people, and charge for rides. And then, you know, hopefully Tesla will have some take rate on it. Now, the biggest problem with you know, getting there is you need to have enough like sort of edge case miles of data collected to convince regulators that the robotaxi is like safe and it's much safer than a human driver. And at some point several years ago, Elon kind of wrote this thing saying, when we have 6 billion miles of data collected, that's when we will be able to achieve full autonomy. They're at like something like 1 billion miles today. Imagine if Tesla stock was a tokenized asset in a blockchain, such that this very powerful, valuable asset could be used to accelerate that data collection. Because the central problem to Tesla is, you know, folks buy the car, they might buy full self-driving, they might not buy full self-driving, but even if they buy it, you know, people aren't turning it on all the time. Like I have my parents, you know, have 2 Teslas and they have FSD on it. They're terrified of turning that thing on. They're worried it's going to crash and there's no incentive to do it. Well, you got to create a really interesting incentive mechanism. And so if you tell a Tesla owner, you'll get streamed some small Tesla stock as payments to your wallet in order to turn FSD on. Well, it's a win-win, right? It's a win for the Tesla shareholder because they get to FSD way faster. And it's a win for the person turning it on. They're kind of helping create that value. So it really, like every business in the S&P 500, if their stock was actually a tokenized asset on a blockchain, can leverage that asset in unique ways that isn't simply just spending ad dollars in Google and YouTube and Instagram, right? So, and then TV ads and all these things. So the point is, like, everyone can benefit from their underlying business. The product itself has to just be great.
Yeah, absolutely. There's a Techstars company, Natix, graduated a couple of years ago, and they're putting cameras on everybody's dashboard and incentivizing them to basically map the world through their cameras through driving around with a token. And that if you map this many miles or is it this many minutes, that's the token you get. And it's working really well. They just raised like a 5 million seed round. So they're doing well. So right there with you on that example. When you and I first talked, Pranav, we talked about the eye-opening experience of how you're running a portfolio of publicly traded assets by running a liquid venture portfolio. And that you touched on that a few minutes ago. But can you tell us a bit about the liquid venture strategy that you run at VanEck and how that day-to-day process works in terms of managing the upside and downside every single minute of every day?
Yeah. So number one, we're kind of hyper aware that these are venture assets with liquidity. So we don't try to like stare at prices all day and try to make decisions based on what different prices are doing. I try to avoid, reading stuff on X or Twitter that makes price predictions and those types of things. It just tends to be a distraction. We have a little bit of a more fundamental lens on the space, and I'll frame it the following way, which is there's probably 300 to 400 million people in the world who own some crypto asset, probably Bitcoin or Ethereum, on some centralized exchange. And then there's, as I said earlier, 20 something million active users of on-chain products. And the central focus for us is what are those things that will drive that 20 million number to a much higher number, into that 300 million and change. The lowest hanging fruit is like the people that own Bitcoin and ETH on these centralized exchanges. What products will they also want to use that are on chain that help these token projects one day? From that perspective, our view is Bitcoin is the only asset that has achieved some product market fit in the world as store value, digital gold. Everything else is still trying to find it. The thing that is on the cusp of finding it are stablecoins at this moment. We think, there's a high possibility that stablecoins that are $160 billion market cap assets today can grow multiples from this point on for a variety of reasons. And so again, we're focused on these use cases that can drive mainstream adoption in the next 2 years. There's a lot of interesting things that can be built on blockchains 5, 10, 15 years from now. And so from that lens, stablecoins is number one. Decentralized physical infrastructure. I know you just mentioned a project that sort of fits in that category, but we have several that are in that bucket as well. That's one other vertical. Gaming is a possibility, and SocialFi is another possibility. Those 4 buckets are closest to sort of finding that hockey stick of user growth. And once we have sort of that view, the sort of the thematic view, what we then try to do is find token projects that look like essentially monopolies in each one of those categories, that also have a great roadmap and a great team, and sort of essentially folks that you can bet on remaining a monopoly or a duopoly in the space. And that's harder to find, right? Because there are a lot of categories in crypto that are just kind of this open source code software projects that have no moat. There's no and the moat is really a network effect in some ways. And so you look at the category, you'll see like 10 different players with about equal amounts of market share, and you don't want to play that space because there's no pricing power there, and ultimately the tokens will be worthless. But again, when you sort of then layer in the main theme and then go deeper, a level deeper, and you say, I want to find monopolies and duopolies in that theme, and great teams and very clear value, then you can whittle it down to, okay, how do we think about the value of the token itself in these projects? What's the upside case? What's the downside case? How does that look relative to other token projects that are also in these categories that we're looking at? And that helps us frame how much of the portfolio something should be. And, we have our initial sizing, and we also take into account sort of market technical factors, right? So which is like basically supply demand on the token side, which is how much supply is there, who's vesting, what's the demand sinks for these tokens, how is it going to trade over the next 12, 24 months. And so all those things together kind of help us formulate a view on if a token should be in our portfolio. If it is, how do we size it? And then we have our kind of core book, and then we risk manage that book from time to time, because at any given point, one of our tokens might be up a lot, one of our tokens might be down a lot, and it might not be justified, so we rebalance things from time to time.
I gotcha. It sounds eerily familiar to the story that a friend of mine who works for a large, well-known market maker shared with me about how they assess projects, is that they do all of the team first product. Does it fit our thesis on how the world will unfold? And then they look at the token and try to understand, is this going to be something that is going to fit into their market making model, right? But obviously a market making model is vastly different than a portfolio management model. So once you get to that token side of the analysis, are the things that you're trying to say, well, this will work more if the token looks like this, or it will work less in terms of your strategy if it looks like that, in terms of the way it trades, in terms of the vesting schedule? How much further into the tokenomics do you go when you're thinking about making an investment?
We go pretty deep in the tokenomics side. As a team, we have a general view, which is we talk to all kinds of pre-token projects just so we get to know the team, and we try to understand what their vision is, and then that way we can start tracking them against that vision and see if they're executing or not. So the earlier we meet a team, the better it is for us, so we can track these things. But we also have a view that the way token projects are launched, they always go through a boom and bust cycle. So, the typical token project raises a seed round, launches a token 18-ish months post their seed round, and launches with a pretty low float for a variety of market structure reasons and a lot of hype. And what that means, it has this sort of very inflated valuation in the first 12 months of its launch. As the 12-month period typically comes to an end, tokens begin to vest, original investors begin to vest, founders begin to vest, and they all probably believe that their token project is very overvalued. They've just observed a big theoretical wealth creation event for themselves on paper. And if that wealth creation event kind of holds, they begin to reduce their exposure. And the hype is at that point also dying. And what you have is a project that goes down 90%. So most token projects typically go down 90% after 12-ish months after they launch. And we're very aware of that. So as a result, we try to avoid projects that are just hot off the shelf that just launched a token. We use that as an opportunity to really learn about them and spend time with them. And then what we try to do is observe what happens after they draw down 90%. We try to then ask the question, is this thing achieving product market fit? Are the original team and founders still committed? Are they still building things that are useful? And is it actually gaining adoption? And this gives us like a 6 to 12 month window to actually ask those questions, observe it in the data, and then begin to establish our positions. So really the sweet spot for us is like 18-ish months after a project has launched in the token form. And so that gives us sort of this optionality to say, is this project going to go to zero, or is it actually going to make it out on the other side?
I got you. That makes sense. And, I like to say that when I see an early stage founder and their tokenomics spreadsheet, more or less, that it's just a spreadsheet, and original tactics that you deploy when you are selling your token in the pre-sale and the private sale and the public sale, and then into the TGE, and then releasing post-vesting, that those are just all artificial constructs to prime the pump of liquidity and to get your product really into the shape where you can have true supply and demand for your token, and that it is operating based on market forces rather than, again, these artificial constructs.
That's when you have like real sort of movement of tokens, and you have more market clearing prices that you can say these are real prices and not sort of this fake inflated price. But more importantly, because these are all venture assets, you're still really betting on the team, the original team, and the labs entity in most cases to deliver and ship. And one of the things I've observed is a lot of these founders, if you think about it from their mindset, they raise a seed round, they don't have any like large amounts of liquidity personally, and they go kind of build this thing, they launch a token, and all of a sudden on paper, they wake up and typically we have an estimate of how much founders and teams take of the token supply. And these guys typically begin to invest somewhere between 6 to 12 months after token launch. So they wake up and they have this massive like liquid wealth creation event where they're like, crap, I have tens of millions of dollars I can go sell and go buy houses and cars with. And, then there are some founders that go do that and they stop really caring about the product, right? I mean, look, my team and I go to like probably 6 to 12 crypto conferences a year, and we're talking to these teams, on a weekly basis, you start to observe a change in the founder behavior as they begin to invest their tokens. And when you start to see that, that's kind of when you're like, look, I don't know if I want to bet on this team anymore as much as I like them. Because they're going to now either not build what they want to build, or they're going to build based on ideology and not what's right for the market. They don't take the market signals into account because they're already rich, right? So they'll just build often based on their ideology.
Yeah, I kind of always use, hey, what hotel are they staying in as a benchmark, right? Is it necessary to have that nice of a hotel?
Yeah. Or if you show up to 6 conferences in 6 months and you see them there over and over again, and they're kind of at like every kind of cocktail event and, just socializing constantly, like, well, who's building the thing? Like if you're always in these conferences.
Exactly. Yeah. I know. Yeah, I hear you. And we talked a little bit about already, Pranav, some of these catalysts that you see for growth, and that you're looking at stablecoins, SocialFi, gaming, DePIN or decentralized physical infrastructure networks. When you step back a bit, are there kind of some societal factors that you think will drive towards getting this 10 to 12 million of daily on-chain users up to the 300 to 400 million or even the billion that people are talking about?
I think stablecoins are where things are just ripe for that mass adoption moment, mostly because it has buy-in from, or at least it's getting buy-in from most of the important constituents. And to be more specific, I think US dollar stablecoins are the ones that I think will dominate in the next 3 years. If you think about it, politicians and governments in the US or regulatory bodies in the US should like it because stablecoins have become a large purchaser of US treasuries. So as stablecoin market caps get greater from creations, those creations drive purchases of treasuries, T-bills more specifically. And that's great because politicians want to run budget deficits, and someone's got to kind of fund that budget deficit. The bigger sovereigns that used to buy US treasuries are slowly stepping away. You can just look at how much of US treasuries China used to buy and what they're buying today. Someone's got to kind of step in for that. And what's interesting about that is most of that stablecoin interest could be international, folks in developing markets that want exposure to dollars that have historically had a hard time getting dollars. This is a very easy way to get them dollars. So you might almost, let's just say certain governments who want to buy US treasuries, the population of that country through this proxy stablecoin way could still become a buyer of US treasuries. Governments want it, people want it for this reason, and merchants ultimately for commerce should want it because it reduces the fees they pay to the credit card companies and the banks. So there's sort of this, I think, perfect lineup of interests on US dollar stablecoins. What's been holding that space back has been the regulatory side, which is, look, big businesses, e-commerce players or brick and mortar players that have an operating business today. I'm sure they're sitting there saying, look, like I see these headlines about different crackdowns happening in the crypto space. Do I really want to burden myself with all of that by starting to kind of experiment with stablecoins? That's kind of been part of the issue. So to the extent you can solve that, I think that's something that can go widely, mass adopted quickly.
Yeah, I think so too, that it's stablecoins have gotten this far as an unregulated asset. And imagine if it were to be regulated, then where's this going to go? And it's kind of like trying to hold it similar to Bitcoin, even though Bitcoin is not regulated. It's the products, the ETFs that now hold Bitcoin are regulated, that it's gone through the roof. Yep. So I'm trying to look at the regulatory path for stablecoins in the same light as the crypto ETFs, and holding up on this side of the pond in Europe, Mika, the first part of Mika that is going live at the end of this month is the stablecoin part of it. But as we know, stablecoins are in the overwhelming majority US dollar, not euro. So we need the US story to unfold in terms of the legislation around this. And there've been some positive green shoots recently, but I'm very excited to see where this all goes when stablecoins do become regulated in the US.
So the story this year has been, Bitcoin's up 50-something%. The altcoin market is actually down in aggregate. So you're seeing this big dispersion, and everyone's really focused on, this stuff happening with prices. And what I'm telling folks is like, let's focus on the bigger picture for a second here, which is something interesting has happened on the regulatory side, which was when Trump was president, he was not the most crypto friendly president, but all of a sudden, early May, he comes out swinging and he's very supportive of the asset class. And that results in several Democrats in the House and the Senate starting to become more friendly and wanting to pass legislation. And the FIT21 bill, which is a crypto market structure bill, passed the House. The question is like, is there a version of that passes the Senate and then makes it to the White House? Still kind of like, open for debate. But there is a window here where a crypto market structure bill can pass this year pre-election, because there's data points out there that suggest that 1 in 5 voters in swing states are single issue voters around crypto. So it's become an election issue, which is now forcing this thing to be a bipartisan thing.
Mm-hmm.
So I think there's this window here where if the legislative piece plays out in a favorable way, then there's certain assets within the crypto space that can perform really well as a result of true adoption.
Yeah. And I'm hopeful as well that FIT21 does make it through. Speaking of the bigger picture, Pranav, I was listening to the head of product from a large centralized crypto exchange talk recently about custodying or providing custody for crypto ETFs. And wasn't even just hinting at it, was saying it outright that, listen, the vast machines that they've built to be able to handle this in a 100% automated way, providing custody of crypto for ETFs and dealing with all the market mechanics of that it's not just crypto they're thinking of tokenized securities. And when major market assets get packaged up as tokens. And that always gets me thinking again about the growth of this area and the growth of all of this infrastructure that folks have been building for the last 10 years. But do you see any reusability of the processes that you guys have put in place at VanEck for managing portfolios of digital assets, obviously as a liquid venture portfolio, but when the volume of tokenized security issuances does eventually pick up, is this going to be transferable, what you've done so far?
I would hope so. I
Okay.
think the one thing that's interesting about us is, most of our business is TradFi, and then there are several crypto verticals, right? Just kind of put some numbers around it. We have over 100 billion of assets under management as a firm. Close to 2 billion of that is in crypto related strategies. And it's the same middle and back office that supports the entire business.
Okay.
So it's the same operations team, same tax team, same accounting team, same IT team, right? So our entire, let's just say, infrastructure has had to learn the nuances of not only crypto custody, but also accounting and tax and especially the legal side of things. So we've over the last several years kind of built up this know-how. When the day does come where we can have, let's just say, tokenized ETFs on chain, then I would think that we've built this sort of institutional knowledge and how we can kind of be fast and first to market with things like that.
Great. Yeah. It's, the basis of this is once you start to think about the trade is the settlement. That makes a back office context much different than it is in the traditional financial markets, right?
Yeah. And there's also other aspects of it, right? Which is the settlement processes today are a little manual. So because, for our strategy, for example, we use qualified custodians. Yep. So, like an Anchorage is a qualified custodian. But when we have to move assets for settlement, you have these digital approvers that have voice and face recognition and that whole thing. That's very, very different from the settlement of how you settle a stock or a bond. And the entire organization has had to learn about it. And then we're all kind of used to it at this point. I think most people would prefer to settle all assets the way we settle crypto. Because one of the things about big organizations is when there's a whole new thing introduced to the organization, there's so many people that have to get trained and learn. And then, I think at least for us, we've done that at this point because of having these strategies. And so if and when there's a day where you have tokenized securities, then everyone kind of knows how it all works.
What's one thing you'd like to see more from your TradFi asset management brethren when it comes to crypto and broader digital assets?
More push towards tokenized equities. Like that's like, I think, a lot of people I talk to are like trying to tokenize private funds or trying to tokenize different fixed income like instruments. That's great and all, right? Like there's like cost savings and exciting things with that. I think if our theory here that stablecoin market cap is going to grow from 160 billion to say a few trillion in the next few years, but again, that's dollar stablecoin. And a lot of that is going to be in the hands of people outside the United States, right? Like there's not that many reasons why, I need to have stablecoins in my wallet. Like the fintech ecosystem has served me well in the United States. But the real demand is like dollars outside the United States. Well, those people will have stablecoins, and those stablecoins today can either buy some money market funds, like, the BlackRock money market fund on chain, or can then go the other end of the risk spectrum and buy a bunch of liquid tokens and meme coins, right? There's nothing sort of down the middle. They'll want to own assets that are not on either end of let's just say, the risk spectrum. We think, tokenized securities, so tokenized equities and ETFs are that product where if you get that stablecoin growth, that actually can end up in these tokenized equity-like assets.
Yeah, I'm glad you raised that, because so much of the market rhetoric towards that is that, well, listen, there's more room for cost efficiency in assets outside of the equity asset class. But a wise person once told me, if you're going to try to get someone to do something to change their whole tech platform, don't tell me how I can save money. Tell me how I can sell more.
Yep.
And I think the point is, with tokenized equities, you could just sell a whole lot more of those. Doing through the domestic markets today, and through some of the international markets as well. In terms of your day-to-day activity, Pranav, that with your approach to investing in liquid venture, what are your favorite tools to use to stay on top of the daily juggernaut of crypto activity that we've all become accustomed to?
Yeah, so we're more fundamental focused than technical focused. And so when I say that, people automatically think, wait, are you looking at price to free cash flow on the next 12-month basis? And my answer is no, that's not how we look at this. You almost have to look at these projects from this, a little bit like with a biotech lens, where we're either going to sit at 20 million users on a monthly basis, or we're going to go to hundreds of millions of users. So there's no real kind of middle ground here where we kind of just muddle along for a while. And what we try to do is sort of say, if a billion people end up on chain one day, 3-5 years from now, let's just say most of them are just on chain because they're holding some stable coins and maybe doing some other things on chain. How does that value then accrue to the project we're investing in? And what are the right ways of measuring whether this project is actually participating in it or not participating in it? And for that, you essentially need to kind of query the blockchain and query the right relevant data. So, we're often using something like the Dune dashboard, or we're using a tool like Artemis, or we're using a tool like Token Terminal to be able to track those KPIs that are relevant for each individual project to, again, answer that question of, is this thing participating in that adoption story or is it not?
Yeah, no, that's a great way to look at it. We come to the point of our chat, Pranav, where I do like to ask the last question that I ask everybody on this podcast. What is one thing that people wouldn't expect to know about you?
I have a hobby with, producing music and also DJing, something I picked up several years ago. And one of the things I learned through both the process of learning those things is less is more. So being deliberate and doing fewer things, especially when you're producing music. So, you're layering, let's just say, a whole bunch of instruments and drums and just sampling things. And when you start to learn how to produce music, your first instinct is to put a lot of things together because you're excited, right? You're I can do so many things. It's super exciting. And turns out fewer high quality actions yield a better result than a lot of action. And I think that sort of thought process is even, you can even translate that to investing.
You can, and to cooking. It makes me think of when I first started trying to do some serious cooking when I was maybe about 28, 29 years old. And I would concoct these elaborate things.
Yep.
Right. With shrimp, with chicken, with roasted peppers, with cream sauce, with everything baked inside pastry.
Yeah.
And I was like, one, this is not sustainable. Two, it kind of just is unpalatable after a while. Even though it tastes good the first time.
Yeah.
Now I just keep it simple.
Yeah.
And pan-fried salmon. So simple. And it comes out so well if you do it right.
Yeah.
And that is my go-to. So right there with you, from DJing to cooking to investing, keep it simple.
Yep. No, I totally agree. And that's something we try to do. Yep.
Very good. All right, Pranav. Well, listen, this has been a fantastic chat. Really appreciate you coming onto the show to do this with me. So thank you.
Thank you. This is great.
That does it for this week, folks. Thanks to Pranav Kanade for opening up his mind to help us figure out why he does what he does. For show notes, resources, and how to get in touch with Pranav, check out our website, moneyneversleeps.ie. If you like what you heard, please leave us a rating and a review on Apple Podcasts or Spotify, as it helps others to find the show. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early-stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie and how to get in touch, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.